Yesterday, Wall Street tried to annihilate your silver position. They dropped the paper price to $86. I told you on this channel it was a coordinated institutional shakeout. I told you the algos were hunting your stop losses. I told you to ignore the fake liquidation candle. And today, Friday, February 27th, 2026, silver took its absolute revenge. We are trading at $92 an ounce right now. Gold is holding firm above $500 and $200. The breakout is real. The momentum is undeniable. But let me tell you something that is going to completely terrify you about why this $92 silver price is just the beginning of a move that will take us past $100 within weeks. Today, buried underneath the surface level financial headlines that Bloomberg and CNBC are feeding you, Jack Dorsey's fintech giant Block just announced the most catastrophic workforce reduction in modern corporate history. Block fired 4,000 employees. That is 50% of their entire workforce gone, replaced by artificial intelligence. This is not a normal corporate restructuring. This is the beginning of what macroeconomic analysts have been warning about since late 2024. This is the start of the global intelligence crisis of 2028. And the only way the United States government can prevent total societal collapse when millions of white-collar workers lose their paychecks to AI is to print trillions upon trillions of dollars in universal basic income. That hyperinflationary money printing is exactly why institutional money is front-running the silver market right now at $92. They know what is coming. They know the purchasing power of the dollar is about to be obliterated. And they are positioning themselves in the only hard asset that cannot be digitally replicated, physical silver. Now, the suits in the legal department want me to tell you this is not financial advice. Of course, it is not financial advice. This is a mathematical breakdown of a collapsing fiat currency system being destroyed by technological unemployment and government hyperinflation. This is a survival guide for a burning theater. Do your own research. Consult a financial advisor if you still trust the people who told you inflation was transitory in 2021. But let me be very clear with you. What I am about to show you today is not conspiracy theory. This is raw data analysis. This is connecting the dots between artificial intelligence, mass layoffs, collapsing consumer demand, government desperation, and the inevitable hyperinflationary universal basic income tsunami that will send precious metals into the stratosphere. Let me know in the comments below. Are you seeing artificial intelligence replace jobs in your specific industry? And are you buying physical silver to protect yourself from what comes next? I want to hear from software engineers, from accountants, from customer service reps, from logistics coordinators. Tell me what you are seeing on the ground, because the official employment data from the Bureau of Labor Statistics is an absolute lie. They are not tracking the AI displacement wave. They are hiding it. Let me walk you through the macroeconomic domino effect that is happening right now in February 2026. Block is a massive fintech company. They run Square. They run Cash App. They process billions of dollars in transactions. And yesterday, they just told 4,000 highly paid white-collar employees that they no longer have jobs. Those are people making $60,000, $80,000, $100,000 a year. Software engineers, product managers, customer support specialists, data analysts, all replaced by machine learning algorithms and large language models. Now, think about what happens when 4,000 people suddenly stop receiving paychecks. They stop spending money at restaurants. They stop buying new cars. They stop upgrading their iPhones. They stop paying rent at premium apartments. Consumer spending drops. And consumer spending is 70% of the United States gross domestic product. 70%. When consumer spending collapses, corporate revenues collapse. When corporate revenues collapse, stock prices collapse. When stock prices collapse, pension funds collapse. When pension funds collapse, retirees lose their savings. This is a deflationary death spiral. Now, I need you to understand something critical. Wall Street is absolutely terrified of deflation. They are not afraid of inflation. They can profit from inflation. They front-run the money printing. They buy assets before the currency debasement hits. But deflation is their nightmare scenario. Deflation means falling prices, collapsing revenues, bankruptcies, loan defaults, and banking system failures. The Federal Reserve's entire mandate since 1913 has been to prevent deflationary bank runs. So when the AI job displacement wave starts to create deflationary pressure in the economy, the Federal Reserve and the United States Treasury have only one mathematical response. They have to print money, massive amounts of money. They have to inject liquidity into the system to prevent the deflationary collapse. But here's the trap. Here's the corner they have painted themselves into in 2026. They cannot just bail out corporations again like they did in 2008 and 2020. The public will not accept it. There will be riots in the streets if they hand another $10 trillion to JP Morgan and Goldman Sachs, while working class Americans are losing their jobs to artificial intelligence. So the only politically acceptable form of money printing in 2026 is universal basic income. They will be forced to send monthly checks directly to displaced workers. $1,000 a month, $2,000 a month, whatever number they calculate will prevent social unrest. And let me tell you exactly what happens when the government starts printing trillions of dollars in UBI. Hyperinflation, not the fake transitory inflation they lied about in 2021. Real hyperinflation. Because when you hand people free money without increasing the supply of goods and services, prices explode, the velocity of money accelerates. People spend those UBI checks immediately on food, rent, gasoline, and basics. Demand surges. Supply cannot keep up, because the factories and the supply chains are also being automated and disrupted by AI. Prices spike, the dollar loses purchasing power, and the only assets that maintain value are hard assets, physical commodities, gold, silver, real estate, farmland, things that cannot be printed, things that have intrinsic utility. This is why silver hit $92 today. This is why gold is above 5,200. The smart money is front-running the UBI hyperinflation wave. Now let me show you the data that proves this is already starting. Today, February 27th, the Producer Price Index came out. The PPI measures wholesale inflation, the prices that manufacturers and wholesalers are paying for goods before they reach consumers. And the PPI came in hot. It showed that wholesale inflation is still rising. It is not cooling. It is accelerating. The official year-over-year PPI inflation rate is now tracking above 3.4%. That is higher than economists expected. That is higher than the Federal Reserve wants. And that is before the UBI money printers have even turned on. Imagine what happens to the PPI when the government starts injecting $2 trillion, $3 trillion, $5 trillion of universal basic income into the economy. Wholesale prices will absolutely explode. And those wholesale price increases get passed directly to consumers. Grocery prices go up, gasoline prices go up, electricity prices go up, rent goes up, everything goes up except wages, because there are no wages, because artificial intelligence took the jobs. This is the hyperinflationary trap that the United States is walking into in 2026. And the only people who will survive this wealth destruction are the people holding hard assets. Physical silver is the single best asymmetric trade in this environment. Why? Because silver is massively undervalued relative to gold. The gold to silver ratio is still above 56.1. Historically, that ratio has been 15 to 1. In a hyperinflationary environment where both metals are rising, silver closes that ratio gap violently. If gold goes to $6,000, silver should be at $400 based on the historical 15-1 ratio. But even if we only see a move to a 30 to 1 ratio, that puts silver at $200 an ounce. And we are sitting at $92 today. That is a 100% return just from ratio reversion, not even accounting for the absolute price increase from monetary debasement. I connect these massive technological and macroeconomic dots so you can see the fiat currency collapse coming miles away. If this breakdown helps you understand the true value of your physical ounces today, consider hitting that super thanks button below to support the channel. Because I guarantee you will not hear this analysis on CNBC. They will not tell you that Jack Dorsey firing 4,000 people is a leading indicator for universal basic income hyperinflation. They will spin it as corporate efficiency. They will say AI is good for productivity. They will ignore the macroeconomic consequences of mass technological unemployment. But you and I know better. We see the chessboard. We see the moves 3 steps ahead, and we are positioning accordingly. Now, let me give you the forecast. Let me tell you where this is going in the next 7 to 14 days. The system is entirely trapped. There is no way out. The economy is breaking down from artificial intelligence displacement. Inflation is rising based on today's PPI data. And to make matters exponentially worse, the geopolitical situation is on the verge of exploding. This Sunday is March 1st, 2026. That is the deadline the United States military gave to Iran. The ultimatum was clear: stop the proxy attacks through Houthi forces in the Red Sea or face direct military consequences. That deadline is 2 days away, and Iran has not backed down. The Houthis are still launching attacks on commercial shipping. The Strait of Hormuz is still a powder keg. 20% of global oil supply flows through that choke point. If the United States launches airstrikes on Iranian oil infrastructure this weekend, crude oil will spike to $120 a barrel by Monday morning. Gasoline will hit $6 a gallon in the United States. Inflation will accelerate even faster. The Federal Reserve will be forced to choose between crashing the stock market with rate hikes or destroying the currency with rate cuts and money printing. They will choose money printing. They always choose money printing because the alternative is immediate economic collapse and political revolution. So you have artificial intelligence destroying jobs, government preparing universal basic income, wholesale inflation already rising, and a potential Middle East war breaking out in 48 hours. This is the perfect macroeconomic storm. This is the exact scenario that drives precious metals into a parabolic blow-off top. And the institutional WAF algorithmic models are now officially targeting the $100 resistance level for silver. I have been tracking these accumulation patterns since silver broke through $80 in early February. The ALOS are systematically absorbing every dip. Yesterday's drop to $86 was a liquidity grab. They triggered the stop losses, shook out the weak hands, and then violently reversed the market higher. Today, we are at $92. The next resistance level is 95. After 95 breaks, there is no significant resistance until 100. And once 100 breaks, we are in price discovery mode. There is no historical precedent for silver trading above $100 in modern markets. The last time silver hit its inflation-adjusted all-time high was 1980 during the Hunt Brothers squeeze, and that peak would be equivalent to over $150 in today's currency. We are not even halfway there yet. I'm going to be monitoring the geopolitical wires all weekend long to see what happens with the March 1st deadline and how the algorithmic trading desks react on Sunday night. The futures markets open at 6 p.m. Eastern on Sunday. If there's any news out of Iran, any military strikes, any escalation, the precious metals futures will gap higher instantly. I will be recording emergency updates for the channel. Make sure you're subscribed to the channel with the bell notification turned on so you get my emergency weekend updates, because if silver gaps from $92 to $100 on the Sunday night futures open, you need to know immediately. You need to understand what is happening and how to position yourself before the Monday morning cash market opens. Let me also explain something that Wall Street does not want you to understand. They want you to think that the price you see on the screen, the $92, is the real price of silver. It is not. That is the paper price. That is the price of COMEX futures contracts. That is the price of ETFs that do not actually hold the physical metal. That is the price of synthetic derivatives that are rehypothecated 50 times over. The real price of silver is what you pay at your local coin dealer for physical ounces. And I guarantee you, if you walk into a bullion dealer today, you are not buying silver for $92 an ounce. You are paying a premium. You're paying $95, $96, $97, depending on the product in the dealer. That premium is the physical market telling you that there is more demand than supply. That premium is the real market price. And as this AI jobs crisis accelerates and the government starts printing UBI, that premium is going to explode. You will see $10, $15, $20 premiums over spot, because there's not enough physical silver to meet the demand from people trying to protect themselves from currency debasement. Think about the supply-demand fundamentals for a moment. Total above-ground silver inventory that is available for investment is estimated at around 2 billion ounces. That sounds like a lot until you realize that there are 8 billion people on planet Earth. If just 10% of the global population decided they wanted to own 1 ounce of silver as insurance against fiat currency collapse, that is 800 million ounces of demand. That is 40% of the available supply. And we are not even talking about industrial demand. Silver is used in solar panels, in electric vehicles, in electronics, in medical equipment, in water purification. Industrial demand consumes about 600 million ounces per year. Mining production is about 800 million ounces per year. The market is already tight. There is no buffer. There is no strategic stockpile. The United States government sold off its entire silver reserve decades ago. They have 0 ounces. China has been aggressively accumulating. India has been accumulating. Sovereign wealth funds have been accumulating, and now you have the AI jobs crisis creating a new wave of retail demand for middle-class workers who are terrified of losing their income. This is a supply shock waiting to happen. And supply shocks in commodity markets create vertical price moves. Look at what happened to palladium in 2021. Look at what happened to uranium in 2024. Look at what happened to cocoa in 2025. When a physical commodity market runs out of inventory, the price does not go up 10% or 20%. It goes up 100%, 200%, 300% in a matter of months, because there is no substitute. You cannot print silver. You cannot create it out of thin air. You have to mine it out of the ground, refine it, fabricate it, and deliver it. And that process takes time. If demand surges because of universal basic income, hyperinflation, and geopolitical instability, the price will have to rise enough to destroy demand. That means silver will have to go high enough that people stop buying it. And in a hyperinflationary environment where the dollar is losing 5%, 10%, 15% of its purchasing power per year, people will keep buying silver at $100, $150, $200, because it is still cheaper than losing half their wealth to inflation. Now, let me address the skeptics. Let me address the people who are going to say, this is fear-mongering. This is conspiracy theory. This is exaggeration. Artificial intelligence is not going to replace that many jobs. Universal basic income is not going to happen. The government is not going to print trillions of dollars. To those people, I say, look at the data. Look at what just happened at Block. 4,000 people fired, 50% of the company. That is not a theory, that is a fact. That happened yesterday. Now, extrapolate that across the entire economy. Goldman Sachs published a research report in 2023 estimating that artificial intelligence could replace 300 million jobs globally. 300 million. The International Monetary Fund warned in 2024 that 40% of global employment is exposed to AI disruption. 40%. We are not making this up. These are official estimates from mainstream financial institutions. And those estimates were made before the latest generation of AI models, before the multimodal systems, before the agentic AI that can actually perform complex white-collar tasks autonomously. The AI capabilities in 2026 are exponentially more advanced than what existed in 2023 when those initial forecasts were made. The job displacement is going to be faster and more severe than anyone predicted. And universal basic income is not some fringe idea anymore. It has been tested in multiple countries. Finland ran a UBI pilot program. Kenya has ongoing UBI experiments funded by Silicon Valley donors. Andrew Yang ran for president of the United States in 2020 with UBI as his central policy platform. The concept has mainstream political support. And when you have millions of unemployed workers who cannot find jobs because AI has automated their roles, the political pressure to implement UBI will be overwhelming. Politicians will have no choice. They will either pass UBI or face mass protests, civil unrest, and potential revolution. So they will pass UBI, and they will fund it the only way governments ever fund anything they cannot afford. They will print the money, they will expand the monetary base, they will monetize the debt, and the dollar will collapse in purchasing power. This is not a prediction. This is a mathematical certainty based on historical precedent. Every single fiat currency in history has eventually failed. The Roman denarius, the German paper mark, the Zimbabwean dollar, the Venezuelan bolivar, all of them collapsed because the governments printed too much money. And the United States dollar is no different. It is just taking longer to collapse because it is the global reserve currency. But that reserve currency status is eroding. The BRICS nations are building alternative payment systems. China and Russia are settling oil trades in yuan. Saudi Arabia is accepting yuan for crude oil. The petrodollar system that has supported the dollar since 1974 is breaking down. And once the dollar loses its reserve currency status, there is nothing holding up its value except the faith and credit of a government that is $35 trillion in debt and running $2 trillion annual deficits. That faith is evaporating. That credit is being downgraded. And the only rational response is to own hard assets that cannot be debased. Let me give you another historical parallel. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. That was the moment the United States went to a pure fiat currency system. And what happened to gold and silver prices after 1971? Gold went from $35 an ounce to $850 an ounce by 1980. That is a 24x return in 9 years. Silver went from $50 an ounce to $50 an ounce. That is a 30x return. And that was during a period of much slower monetary expansion than what we are seeing today. The M2 money supply in the 1970s expanded at an average rate of about 10% per year. Today, the M2 money supply has expanded by over 40% since 2020, 40% in 6 years. If you apply the same precious metals price response to that level of monetary debasement, gold should be trading at $15,000 an ounce, and silver should be above $500. We are not even close to those levels yet. Gold at $5,200 and silver at $92 is still massively undervalued relative to the monetary inflation that has already occurred. And we have not even discussed the derivatives bubble. The global derivatives market is estimated at over $1 quadrillion in notional value. 1 quadrillion. That is a 1 with 15 zeros. Most of those derivatives are interest rate swaps and currency swaps. And when you have a hyperinflationary environment combined with AI-driven economic disruption, those derivatives start to blow up. Counterparty risk explodes. Banks that are on the wrong side of interest rate bets face catastrophic losses. We saw a preview of this in March 2023 when Silicon Valley Bank collapsed because they had long-duration treasury bonds on their balance sheet and interest rates spiked. They were forced to realize massive losses and depositors ran. The FDIC had to step in. The Federal Reserve had to create a new emergency lending facility to backstop the banking system. That was just one regional bank. Now imagine what happens when the entire banking system is facing the same duration mismatch problem because inflation is rising, interest rates volatile, and the Federal Reserve is trapped between fighting inflation and preventing financial collapse. They will choose to prevent financial collapse, they will cut rates, they will inject liquidity, they will bail out the banks, and that liquidity injection will accelerate the inflation. It is a vicious cycle, a doom loop, and the only way to escape the doom loop is to own assets outside the banking system. Physical gold and silver that you hold in your possession. not in a vault, not in an ETF, not in a futures contract. In your hand, in your safe, under your control. I also need to talk about the geopolitical dimension of this crisis because the AI jobs collapse and the UBI hyperinflation are happening at the same time that the global power structure is shifting. The United States is losing its economic dominance, China is rising, Russia is resurgent, the BRICS bloc is expanding, and all of these countries are accumulating gold. China has been buying gold every single month for over 2 years straight, according to official People's Bank of China data. And that is just the official data. Many analysts believe China is buying far more gold through off-balance sheet channels and proxy entities. Russia has been accumulating gold since 2014 after the West imposed sanctions over Crimea. They learned that holding U.S. Treasury bonds and dollar reserves makes them vulnerable to Western financial warfare. So they diversified into gold, and now their gold reserves backstop the ruble and give them financial independence from the dollar system. The BRICS nations are also discussing the creation of a gold-backed trade currency. This has been reported in mainstream financial media. It is not conspiracy theory. The idea is to create a currency unit that is partially backed by gold and used for international trade settlement between BRICS members. If that currency is launched and it gains traction, it will directly compete with the US dollar as a reserve currency. And if countries start holding BRICS, gold-backed currency instead of US Treasury bonds, the demand for dollars will collapse, the dollar will depreciate, and the United States will face a currency crisis. The Federal Reserve will have to print even more dollars to monetize the debt because foreign buyers will stop purchasing treasuries, and that will accelerate the hyperinflation. This is the geopolitical endgame. This is why the March 1st Iran deadline matters so much. If the United States gets dragged into another Middle East war, it will further weaken the dollar, further damage U.S. credibility, and further accelerate the global shift toward alternative reserve assets like gold and the BRICS currency. So when you combine the AI jobs crisis, the UBI money printing, the rising wholesale inflation, the derivatives bubble, the banking system fragility, and the geopolitical shift away from the dollar, you have the perfect storm for precious metals. And that is exactly what we are seeing in the price action today. Silver at $92 is not a bubble. It is not a speculative mania. It is rational capital flows moving out of fiat currency and into hard assets. The institutional money knows what is coming. The sovereign wealth funds know what is coming. The central banks know what is coming. That is why they are accumulating gold. That is why the price is rising. And retail investors, everyday working people, are finally starting to wake up to the reality that their dollars are being systematically devalued and they need to protect themselves. But here is the critical point. You cannot protect yourself with paper silver. You cannot protect yourself with an ETF like SLV that may or may not actually hold the physical metal. You cannot protect yourself with a futures contract that can be cash settled. You need physical silver, coins, bars in your possession. Because in a real crisis, in a real banking system collapse, in a real hyperinflationary spiral, the paper markets will freeze. The ETFs will suspend redemptions. The futures exchanges will impose position limits and force liquidations. We have seen this happen before. In March 2020, during the COVID panic, the gold and silver futures markets went into backwardation. The physical premium exploded. Dealers ran out of inventory. People could not buy physical metal at any price, and the COMEX futures price was completely disconnected from the physical market. That was just a 2-week liquidity crisis. Imagine what happens in a 6-month or 12-month crisis when the government is printing trillions in UBI, and the public is panicking about currency collapse. The premium on physical silver could go to 50%, 100%, 200% overspot. You could be looking at a situation where paper silver is trading at $100 and physical silver is selling for $200. That is not impossible. That is what happens in a real supply shortage. And the silver supply shortage is very real. Mining production has been flat for years. There are no major new silver discoveries. Most silver is produced as a byproduct of copper, lead, and zinc mining. So silver supply is inelastic. It does not respond quickly to price increases. If silver goes to $150, it does not mean miners will suddenly produce twice as much silver. It takes years to develop new mines. It takes years to expand production. And in the meantime, demand is surging. Solar panel production is surging. Electric vehicle production is surging. 5G infrastructure is surging. And now you have investment demand surging because of the AI jobs crisis and UBI fears. The supply-demand imbalance is going to get worse before it gets better. And that means higher prices, much higher prices. Let me also address the people who say gold and silver are barbarous relics, that they have no place in a modern digital economy. To those people, I say, look at what is happening in 2026. Look at the rise of central bank digital currencies. Look at the push for programmable money. Look at the social credit systems being implemented in China and proposed in other countries. The governments want total control over your money. They want the ability to freeze your accounts, to limit your spending, to tax your transactions in real time, to implement negative interest rates, to enforce capital controls. A central bank digital currency gives them that power. And the only way to escape that control is to hold assets outside the digital system. Physical gold and silver cannot be hacked. They cannot be frozen. They cannot be confiscated remotely. They cannot be devalued by a software update. They are the ultimate monetary freedom. They are the ultimate insurance policy against technocratic financial tyranny. And this brings me back to the Jack Dorsey AI layoffs. This is not just about job losses. This is about control. The same Silicon Valley elites who are building the AI systems that will replace human workers are also the people advising governments on central bank digital currencies and programmable money systems. They are engineering a future where most people are dependent on government UBI payments that are distributed through a digital currency system that can be controlled and monitored in real time. This is not science fiction. This is the explicit agenda of organizations like the World Economic Forum. They talk openly about the fourth industrial revolution, about the fusion of physical, digital, and biological systems, about stakeholder capitalism and public-private partnerships. And the end game of all of this is a system where you own nothing. You have no privacy, and you are completely dependent on the state and the corporations for your survival. Physical silver is your escape hatch. It is your exit strategy. It is your declaration of financial independence. Now, let me give you the tactical playbook for the next 2 weeks. This weekend, monitor the news on the Iran situation. If there's military escalation, precious metals will gap higher on Sunday night. Be ready to act. If you have been waiting to buy physical silver, do not wait anymore. $92 might look expensive today, but it will look cheap in 3 months when we are at $130. And if you already own physical silver, do not sell. Do not let the paper market volatility shake you out. Remember, yesterday they dropped the price to $86. Today, we are at $92. That $6 move in 24 hours is the algo hunting stops. They want you to panic. They want you to sell. Do not give them your metal. Hold, accumulate on dips, and if you have the capital, buy more, because the fundamentals have never been stronger. The macroeconomic case for silver has never been more compelling, and the risk-reward ratio is asymmetrically in your favor. The downside is what? Silver drops back to $80. You lose $12 an ounce. That is a 13% drawdown. The upside is silver goes to $150, $200, $300 as the UBI hyperinflation kicks in and the supply shortage intensifies. That is a 100 to 200% gain. Asymmetric. And you're not just speculating on price appreciation. You are protecting your wealth from the systemic collapse of the fiat currency system. You are insuring yourself against the AI jobs crisis. You're hedging against geopolitical chaos and potential war. This is not a trade. This is survival. Artificial intelligence can replace a software engineer. The central bank can print $1 trillion digital dollars with the push of a button, but absolutely no one can print physical silver. No one can create it synthetically. No one can code it into existence. It is a tangible, scarce industrial and monetary metal that has been valued by human civilization for 5,000 years. And it will still be valued 5,000 years from now, long after every fiat currency currently in existence has collapsed into worthlessness. If you want to see exactly how I am positioning my portfolio to survive the AI jobs purge and the UBI inflation wave, if you want access to my detailed trade setups, my bullion dealer recommendations, my vault storage strategies, and my real-time market updates, click the join button and become an insider member right now. The member-only content is where I go deep on the technical analysis, the geopolitical intelligence, and the actionable strategies that you need to navigate this crisis and come out the other side wealthier and more secure than you are today.